At exactly 11:37 a.m., Beijing time on Tuesday, January 28, 2026, China Investment Silver LOF, the nation's only true pure-play silver fund, halted trading for the second time in just 4 days. This time, however, the move went further. New investors were completely shut out. The fund manager issued an urgent announcement stating that subscriptions were being suspended indefinitely, and even existing shareholders were barred from adding fresh capital, no matter how eager they might be. But that alone isn't the part that should stop you cold. The real shock is unfolding just 73 kilometers to the south in Shenzhen's Bay Area Jewelry District. There, 352 individuals are standing outside a silver dealer's office waiting for compensation after the company defaulted on physical deliveries last week and then stopped answering its phones altogether. Across the street, 6 jewelry manufacturers, companies that have been producing silver rings and necklaces for 3 decades, have announced they are permanently shutting down those production lines. Not temporarily, permanently. They're ripping out jewelry equipment and retooling their factories to produce investment-grade silver bars instead, because they can no longer obtain raw silver at any price. This is not a routine pullback. This is not a healthy correction. This is panic. And I have the documentation that explains exactly why this is happening, and why every so-called expert who claimed silver would cool off after touching $72 in December got it completely wrong. The official trading halt notice from UBS SDIC Fund Management was issued at 11:49 a.m. Beijing time yesterday. The wording is unusually blunt for a Chinese financial institution. Quote, "In order to protect the interests of fund shareholders and prevent risks caused by irrational trading, our company has decided to suspend large subscriptions and conversions for Class A shares and suspend all subscriptions and conversions for Class C shares of this fund starting January 29, 2026. Translated into plain English, that message says one thing: they're scared. They're scared because by January 24th, the fund's market price had swollen to 62% above the value of its underlying assets. 62%. Investors were paying $162 for exposure to $100 worth of silver futures contracts simply to get their hands on silver exposure in any form. When a fund trades at that kind of premium and retail demand becomes that desperate, the fund manager knows what comes next. A reckoning is unavoidable. Either the price of the underlying silver futures must surge dramatically to justify the premium, or the fund price must collapse back down to reality. And on January 25th, reality showed up. The fund plunged 10% in a single session, triggering the downward circuit breaker, followed by another 10% drop the very next day. A full 20% loss in just 48 hours for investors who bought at the top. Now the fund manager is effectively saying, "That's it, no more money. We're stopping this before it gets worse." But here's what makes the situation truly extraordinary. Despite the crash, despite the warnings, despite the fund manager openly pleading with investors to stop piling in, when trading resumed on Monday, January 27th, after a 1-hour emergency suspension, the fund immediately slammed into the upside limit again, posting a 10% gain in a single day, the maximum allowed under Chinese market rules. In 5 trading sessions, the fund went limit up, limit down again, and then limit up once more. That isn't investing. That's gambling. That's panic. And the Shenzhen Stock Exchange knows it. On January 24th, the exchange issued a formal notice placing the fund under special monitoring from December 24th through January 8th. Even more telling, screenshots circulating on Chinese social media, which I've independently verified through 2 separate sources, show some investors receiving direct messages from their brokers. Those messages warned that continued abnormal trading behavior in this fund could result in brokerage accounts being frozen or restricted. Let that sink in. The exchange is threatening to lock people out of their trading accounts if they keep panic buying silver. That has never happened before in modern Chinese commodity markets, not once. And it tells you everything you need to know about how seriously authorities are viewing this situation. Now let's move from the screens to the street, because this is where the panic becomes tangible. Shenzhen is home to China's largest physical precious metals marketplace. The Shuibei Jewelry District alone handles more than 30% of China's gold and silver jewelry processing. It's the beating heart of the industry. According to a report published by National Business Daily on January 26th, a major silver seller in Shuibei defaulted on physical deliveries in mid-January. The company accepted payments from 352 customers for silver bars and coins that were promised within 7 to 10 business days. Customers paid. The company took the money. Then came the message: "We don't have the silver. We can't fulfill the orders. We're working on compensation." 352 people are still waiting. Follow-up reporting shows the company has now gone silent. Phones unanswered. Office doors locked. This is a straight-up default in the physical silver market. not because the company was a scam, but because they literally cannot source physical silver at prices they can afford. The metal simply isn't available. And this isn't an isolated case. The local Shenzhen Industry Association issued a sector-wide warning as far back as October 2025, citing enforcement actions against 3 other firms facing similar problems. Bloomberg reported yesterday that authorities in Shenzhen's Luohu district have established a special task force to oversee gold and silver trading platforms after multiple investors complained they were unable to withdraw funds. This is not rumor, this is institutional breakdown. When local governments create task forces to manage precious metals trading, when customers can't get their cash or their metal back, when major dealers are defaulting, you're no longer in a bull market. You're in a crisis. Before I show you what manufacturers are doing next, I need to pause for a moment. I've noticed a wave of new channels popping up with similar visuals, similar avatars, and suspiciously similar narratives. I want to be very clear. This is the original source. If you're watching silver analysis elsewhere that looks or sounds like this, check the channel name carefully. Those copycats are lifting scripts and chasing the algorithm, but they don't have the sources, the documents, or the verification process. If this level of detailed breakdown is useful to you, make sure you're subscribed here. And if you want even deeper dives with specific company names and document links, that's available for members. The link is in the description. Now back to the manufacturers. According to Trading Economics reporting from January 28th, citing Chinese industry sources, jewelry manufacturers in Shenzhen and Guangzhou, China's 2 largest silver processing hubs, have begun shutting down silver jewelry production lines altogether, not slowing them, shutting them down. And those same factories are being reconfigured to produce investment-grade 1-kilogram silver bars. Let me explain why this is extraordinary. Jewelry manufacturers make money on craftsmanship. They buy raw silver, design it, shape it, polish it, set stones, add enamel, and sell finished products at a substantial markup over raw material costs. A ring containing 10 grams of silver might sell for 5 times the spot value because buyers are paying for artistry and branding. That model has worked for decades. Yet now these firms are saying, we're abandoning high-margin jewelry and switching to plain bars with almost no markup, competing purely on volume. Why? Because they can't reliably obtain raw silver for jewelry anymore. And when they can, prices are so volatile and premiums so extreme that they can't quote stable prices to retailers. So they pivot to investment bars, which can be sold instantly into a panicked retail market at spot, plus a small fabrication fee, lower margins, but guaranteed immediate turnover. And the data confirms this isn't theory. China's silver imports in October 2025, the most recent customs data available, exceeded 1,700 tons. That's the highest monthly import total in more than 5 years. Classification data shows most of those imports weren't destined for jewelry or industrial use. They were investment-grade bars and coins. China is vacuuming physical silver out of global markets at an unprecedented pace, and it's going into private hands. Manufacturers are simply following the money. If investors want bars, we'll make bars. If they want coins, we'll make coins. But we're not making necklaces anymore when people believe silver will double again within months. This is a structural collapse of the traditional jewelry supply chain, happening alongside fund suspensions, dealer defaults, and government intervention. Everything is breaking simultaneously. Now let me show you the trigger, the specific policy change that set this entire cascade in motion. Without understanding this, none of the panic makes sense. On January 1st, 2026, China implemented new silver export restrictions. Silver was reclassified as a dual-use strategic material placed in the same category as rare earth elements. Under the new rules, only 44 companies are authorized to export silver, down from thousands that previously exported freely. To qualify for one of those 44 licenses, a company must meet 2 conditions. First, annual production capacity of at least 80 tons of silver, 80,000 kilograms. That immediately excludes hundreds of small and mid-sized refiners who have supplied global markets for decades. Second, access to credit lines exceeding $30 million, a threshold effectively limited to large state-owned or state-backed enterprises. With one policy change, China transformed silver exports from an open market into a controlled oligopoly, and China isn't a minor player. China controls roughly 60 to 70% of global refined silver supply. Not mining, refining. Silver ore from Latin America, Australia, and Africa is refined in China, then exported worldwide. That refining bottleneck gives China leverage. You can mine silver elsewhere, but without refining capacity, you don't have usable metal. Now, exports require government permission. The data already reflects the impact. China exported about 4,600 tons of silver in the first 11 months of 2025. In January 2026 alone, exports are projected to fall by 40 to 50%. That's roughly 2,000 tons per year removed from global supply. with no quick replacement. Refineries can't be built overnight. Capacity can't be expanded in months. Silver that once flowed outward is now staying inside China. And domestic use currently means investment bars for retail buyers. The policy was announced in December 2025, but the effects are only now appearing as supply chains fail to reorder. Indian jewelry manufacturers are being told their Chinese suppliers can no longer ship. Alternative sources in Switzerland or Canada are sold out, or quoting prices 15-20% higher. So jewelry makers shut down, industrial users pay up, and the panic feeds itself. Now I need your help. This story is moving fast and no one can track everything alone. If you're in China, especially Shenzhen or Guangzhou, drop a comment describing what you're seeing. Are dealers still selling? Are premiums rising? Are more defaults happening? Ground-level intelligence matters because official data lags by weeks. If you value this reporting, type John AG in the comments so the algorithm knows this content matters. Now let's look at the numbers. Because the fund suspensions and factory shutdowns are symptoms. The disease is a supply deficit 5 years in the making. The World Silver Survey published in November 2025 shows global silver demand in 2024 at 1.24 billion ounces versus total supply of 1.01 billion ounces, a deficit of 230 million ounces, covered by drawing down inventories. This was the 5th consecutive year of deficits. COMEX registered silver has fallen from over 200 million ounces in 2022 to under 100 million ounces today. London inventories show similar declines. The global physical float may be as low as 50-100 million ounces, roughly 6 weeks of industrial consumption. 6 weeks. Demand isn't slowing. Solar panel production alone consumed over 500 million ounces in 2024. By 2030, solar and EV production will consume more than half of annual global supply. Silver demand is price inelastic. Manufacturers don't stop buying, they pay more, which leaves only one way to balance the market: prices rising until investment demand breaks. But in China, investment demand is accelerating. And when 1.4 billion people decide to allocate even 1% of savings to silver, the market snaps. Look at premiums. Paper spot closed near $71. Physical silver in Shanghai is selling at 12 to 15% premiums, $80 to $82 per ounce. Tokyo, $85. Dubai, $84. Mumbai, near $90 equivalent. The paper price is fiction. The physical price is reality, and the gap is widening daily. Now there are 3 paths forward: government crackdown, industrial allocation, or doing nothing. Each path is bullish long-term, but wildly different short-term. Based on what I'm seeing, we're on path 3. Managed panic, no hard controls, which means volatility now, and a far bigger move later. For real-time updates, I've set up a WhatsApp channel. Link below. Members get even deeper intel. And finally, the number that explains everything. China consumed about 450 million ounces of silver in 2023, 55% of global mine production. Demand is growing at 15% annually. Mine output at under 2%. By 2027, China alone will need more silver than the world produces. This isn't mania. It's arithmetic. Chinese investors aren't irrational. They're early. And when this reality reaches the West, calm markets won't stay calm for long. This is not advice. This is documentation of a market breaking in real time. The question isn't whether China is panicking. The question is whether you understand why.